Hello. We're going to talk about quantitative methods in aircraft financing. But first I want to introduce myself. My name is Nils Hallerstrom. I spent 35 years with PK Air Finance. It's a lender based in Luxembourg that provided loans to airlines and lessors backed by aircraft. I retired at the end of 2018, and since then I have joined the board of Novus Aviation in Dubai and Rockton Aviation in Stockholm. And I also run a professional development program for ISTAT and an online program called the Learning Labs for ISTAT. And then I'm an advisor for Apollo Global Management, who acquired PK after I retired. In 1991, I experienced my first downturn in this industry. And we had several loans that got into real trouble. And we lost a fair amount of money. So I think of myself as somebody with a very expensive education in aircraft financing. And I wanted to share some of the lessons I learned from that experience with you today. And hopefully you will have a less expensive education than I had. So you are at the beginning of your career in this space. And remember that a lot of people who joined this industry after 2008 have never experienced a downturn before. So people were thinking about risk more in theoretical terms, in qualitative terms. But now risk has manifested itself in this downturn because of the corona pandemic that seems to be the deepest downturn so far in the history of commercial aviation. So that is also give you an opportunity to learn a lot about risk. So why do we worry about quantitative methods? Well, this industry started in the 70s, and people who knew a little bit about airlines and aircraft and had contacts across the industry would start leasing or lending, and they were all very successful based on three things. The first one was that there were tax benefits available to lessors. And the second thing is that there was very high inflation, so aircraft values, instead of depreciating, sometimes appreciated. And then there was very little competition in this very specialized industry. Today, all that has changed. There are few tax benefits left, inflation is very modest, and competition is razor sharp. So you need to have a better mousetrap than the competition. Collecting data, storing data, analyzing data, and using that data in algorithms that will help you take better decisions. Today's computers are very powerful and you can do a lot of number crunching. And also there are big strides made in the field of artificial intelligence, so you can build systems that can learn by itself how to make better predictions and forecasts by feeding back outcomes into this system. This is a very exciting field that you will all have an opportunity to participate in during your career. So with that, let's jump into this lecture now. So we're going to first look at the NPV calculation, as you remember from Tom Conlon's lecture, where you simply take the initial investment or the purchase price of an aircraft in the case of a lease, or the initial loan amount in case of a loan, with a negative sign at time zero. This is your investment, a cash outflow, and then you collect periodical cash flows at time n, and you discount those with the interest rate, the discount rate I. And then you have a final payment at the end of the term that you also discount to get the present value. Now, we're going to move beyond this static net present value analysis and introduce the concept of uncertainty, which is the driver of risk. So in aircraft leasing and lending, I think we have basically four primary risk factors. What if the airline defaults and the survival is uncertain? We won't collect those periodical cash flows that we were expecting. And what if the aircraft value at default is not what we had expected when we first did the deal or at the maturity? This value projection is very uncertain and it's a guesstimate. Then you have the time and cost to repossess the aircraft, repair it and remarket it in case you get it back early or at the end of the lease. And this is also subject to uncertainty. And then what should that discount rate be? The discount rate should reflect the risk, and the suggestion is that you use the average weighted cost of capital, but that is just reflecting the risk of your company. It is not reflective of the risk in that particular investment per se. So what is important to remember is that there's more than one outcome possible. So we have basically these risk factors. We have the default risk, we have the aircraft value risk, we have the jurisdictional risk, which is the matter of getting the aircraft back in time and at a limited cost. That all drives risk. And then you have the interest rate risk. So look at these. Let's look at these one at a time. I'm going to start with default risk, the risk that the airline is not going to perform under its obligations. There's a lot of discussion about what default constitutes. Some people say it's when something is late by 30 days or more, an amount over a certain limit, etc., etc. But basically you see and you know default when it happens. And a bankruptcy filing is definitely an event of default, or if the company is unable to meet its obligation in general. So how do we assess the risk of default? Well, typically, lessors and banks assign a rating, some kind of grade that is typically qualitative. And these rating systems can be of several different forms. You have the expert system, when you ask the expert who gives you a subjective and sometimes inconsistent opinion about the creditworthiness of an airline. You can have a credit scoring model, which is very, very common among banks and lessors, where you basically list a number of key factors that you think are important for the financial viability of an airline, and you look at those and you weight them and you score these different factors and you come up with some kind of overall ratio that you then use to assign a rating. Or you can have a structural model which is derived from the equity price or the stock price of the airline and the volatility and the stated liabilities in its accounts. So this gives you like a statistical approach to the probability of default. The problem with this is that not many airlines are listed on stock markets, so that limits this approach to those companies. And the fourth form is what is called the reduced form model, which is derived from trading prices on bonds that the airline has issued or credit default swaps. And you can then implicitly calculate what type of probability default is implied by that pricing. This is also a bit limited because many airlines have not issued bonds that are traded or that are public. So that will limit the population of airlines that could be tracked in this way. Let's look how these rating systems work and how you track them. And I'm going to take an extremely simple example where we have a rating system that is only two states. It's good or bad. And then, of course, you can default and then you're dead. Okay. So the key now to translate this system, the good, bad, and dead, into a quantitative rating system is to establish what type of default probability you would have for each of these buckets over a certain horizon, which is typically 1 year. So in this case, in this example, the good has a 2% probability of going into default within 1 year, and the bad one has a 30% probability of defaulting within 1 year. And then the dead is 100% because it's already dead and you can't be resurrected from the dead. And then the question is, we need to know the default probability not only in the first year, but also in the second year or years beyond that. So to do that, you can establish something called a rating transition matrix. And this is something that the rating agencies do. And in this particular case, with our simple rating system, this is an example of a 1-year rating transition matrix. And what it simply means is that somebody who's rated good at the inception of the year has a 90% probability of still being rated good at the end of that year. But there is an 8% chance that they are going to be rated bad after 1 year. And then, as we said before, 2% probability of being dead. And then if you're bad, you have a 5% probability of being upgraded, 65% probability of staying in the state you started the year at, and the 30% chance of defaulting. And then, of course, if you're dead, there is no chance of being upgraded to something better than dead. You stay and remain dead. Okay, so these percentages are based on empirical data that you have to collect over many years among a very large population of counterparties. And this is something that big banks and big lessors can build up over time. But it's absolutely crucial to have this type of rating matrix to be able to model default probabilities over the term of your transaction. So to get to the second year default risk, what you can do then, if you assume certain things about, that what happens in 1 year is not indicative of what happens next year. So every year is like a unique event, uncorrelated to the previous event, the previous year. You can then just simply multiply this 1-year transition matrix with itself. And the way the matrix multiplication works, you may remember that, is you take, to get the chance of being good after 1 year, if you started off being good after the second year, you take this row, multiply by this column. In other words, 90% times 90% plus 8% times 5% plus 2% times 0%, and that is 81%. And then you can fill all these cells in this matrix and get the 2-year rating transition matrix. And then to get to the 3-year matrix, you do exactly the same thing. You take the 2-year matrix and multiply by the 1-year matrix. Same approach, and you get the 3rd-year matrix. And this is an example of Standard & Poor's 1-year transition matrix. And they have more grades than we had in this very simple system that I took as an example. And this is a real matrix based on real data over many, many years. And Standard & Poor's also has rating modifiers, so they have more steps than this, and there are matrices available for the different steps, but this is like the basic one. And this is available on Standard & Poor's publications, and Moody's and Kroll and Fitch, all these rating agencies will publish these type of matrices, and they can be very, very helpful when you try to model the term structure of your default risk. But instead of default risk, we can look at the survival probability, which is 1 minus the default risk. It sounds better with survival than with default. So if you look at the cumulative survival probability for different rated counterparties based on S&P's matrix, you can see here that the very weakly rated airline or company, CCC here, the line goes down and the chance of survival drops very, very quickly. And then it kind of tapers out like an exponential curve. And then for the better rated credits, you can see that they kind of hang on here to the lower default risk, and then it kind of goes down later on. And this is a typical structure that you see in these type of survival structures, how the very weak rated airlines are convex lines, and the very strongly rated airlines or corporates are concave lines. You can also see that the probability default in any 1 year is just a drop down in the survival probability over a particular year. So let's say you have this system in your bank or leasing company now, and then how do you make this better? Well, the key is to continuously verifying your estimate. You record what you have assigned in terms of ratings for particular counterparties, and then you follow up and see when did defaults happen. And you do a back testing and a continuous recalibration. So estimate, back test, and calibrate. You go around and around and around. And eventually you're going to get a better and better system, the more data that you collect over a longer period of time among more and more corporates or airlines. Now, default is a binary outcome. Either you live or you die. There is basically nothing in between. So to check the goodness of a predictive system, like a rating system, there are two aspects to this. One is the system's power of discriminating between the strong airlines and the weak airlines. And the other one is the absolute level of default, so the systematic average on your default predictions. So these two need to be tested. If we first look at the power and the power of discrimination between the good airlines and the bad airlines, I'm here showing an example where you have 40 airlines, airline 1 through 40, and they have ratings here in an ascending order. So the weakest are on top and the strongest at the bottom. Okay, so this is the rating that was assigned, the probability of default over 1 year. And there was an average rating of 8% across this whole population of airlines. And then after 1 year, you check off the ones that did default. So it turns out that this airline defaulted, this airline defaulted, this airline defaulted, and airline 10 here defaulted. So there were 4 defaults. Okay, and you can see that the interesting thing is that the defaults tended to happen in the upper part of this list. So it looks like, you know, we hit this quite well in the sense that it was the weaker rated airlines that did typically default. Not all of them, but by and large it was in the upper part of the list. So if you now simply accumulate the rank of the ratings here, so from the weakest to the strongest, and let that be the x-axis of your chart, and then you accumulate the defaults. So, you know, there's 4 defaults, so you have 25% represents each of the defaulter, and you see that they've accumulated up to 100% when you come to airline 10. So if you plot this diagram here, where you have the cumulative ranking here from the worst to the best on the x-axis, and then you have on the vertical axis the cumulative by the default flags. You see this orange line will tell you if your prediction was a good one or a bad one, because if this orange line had been smack against the vertical axis and the top line here, it would have been an absolutely perfect system. You would have seen that if you had had airline 1, 2, 3, and 4 default. Now, it wasn't that perfect, but it was quite good. Okay, so let's look at another example. Here, in this example, you see there's a airline number 9 is defaulted, and airline number 17, and airline number 25, and airline number 33. So here it looks like there wasn't much of a predictive power because the defaults actually occurred, you know, in any part of this list. And when you plot the power curve, you can see that this power curve kind of is along the diagonal. So this is more of a random system which has very weak power. And this is something that I think reflects more, you know, something that people can actually achieve. I mean, it's very hard to predict defaults, but this is an example of a power that I think is close to where the rating agencies manage to arrive, and many banks and leasing companies should be somewhere around this level. And the way you then measure this goodness of predictive power, and here's an example of a real financial institution's power curve that is based on empirical data. What you do is that you look at the area between that power curve and the diagonal, and you measure that green area, and you compare to this whole area here, okay, with the diagonal and then the top line and the vertical axis. And so you get the ratio between this area and this whole area. That is called the accuracy ratio. And in this case, it's 67%, which is kind of where rating agencies come out, somewhere between 70 and 60%. So that's, I would say, an acceptable rating system when it comes to predictive power. But the other the other dimension you have to look at is the absolute level of predicted defaults against empirical levels of default. So in this case, the dotted line here is the predicted average level of default among your obligors in terms of the horizon here that is in years. So this is over a 10-year period, and this is the cumulative default rate that was predicted. And this is the average cumulative default rate that has been observed. And you can see here that the default rate that has been observed is actually lower than what was predicted, at least beyond the second year. So this constitutes an overprediction, and this would typically, require a recalibration. Although you have to be careful because you have to do this over a long period of time. And if you have kept calibrating stuff from, say, 2009 to 2019 over 10 years, you may say, oh, we're overpredicting defaults. But then, the COVID pandemic hits and a lot of airlines default. And then it turns out that your system wasn't overpredicting as much as you thought. So you have to be very careful when you calibrate, not to use data over a too short a period of time or across too few airlines. You can also break down this level tracking in different cohorts. In other words, in this case, we have, the better airlines are in one bucket. That's the green line. And the yellow one is in the middle bucket, and the red ones are in a weak bucket. So you see that the green line here is the empirical default rate, and the predicted default rate was somewhere between these two green lines. So you can see that here we overpredicted. We also overpredicted for the mid-range obligors, and we way overpredicted the weak ones after the first year. But in the first year, it seems like it was pretty spot on. So it could be that the shape of that curve is not absolutely perfect, and it could be that this matrix multiplication, where we assume what is called a Markov process, which is a memoryless process, that is not actually totally true. Okay, that was about default risk. So we talked about how we have to rate airlines and then look at those ratings and translate them into probabilities of default, not only over 1 year, but over the full term of the transaction that we're contemplating. And that is a probability distribution of the default risk over time. Then we have to verify our past forecasts and make sure that the power of discrimination between the good ones and the poor ones is strong, and that the overall level of default prediction is correct. Otherwise, we have to constantly recalibrate and try to improve this system. So if there is a default, then we have to worry about what the aircraft is worth. And that's what we're going to turn to now. Okay, we're going to turn to asset risk now, or the risk of the aircraft value, the current and the projected value. So to illustrate the uncertainty around aircraft values, I'm showing this chart that we collected and put together when I was with PK Air Finance. We just got a lot of data from the US Department of Transportation that had a requirement for US airlines to report trading prices of aircraft until 1994, and after that we had a spy network we operated to collect transactions that we recorded in this database, and we plotted this chart. So here a point on this chart shows a resale price as a percentage of the new price of that aircraft, and it's as a function of the age of the aircraft. And then we adjusted the prices to constant dollars. So we removed the effect of inflation. And you can see here that, this transaction and this transaction, although the airplane were also the same age, it was for two different aircraft, and they were done at two different points in time in the calendar space. So you see in this chart two things. One is the scatter, the dispersion of values quite dramatically. And then you see a trend line around this scatter that shows the age depreciation of the aircraft. And if you take the extension of this kind of straight part of the line, you will hit something around 22, 23 years. This is 100 quarters, so it's 25 years, the whole axis. Okay, and the same thing you see if you take the appraiser Ascend's historical current market value data over many, many years for many different aircraft types, and you also look at the normalized values. In other words, they all start with 100%, and then you inflation adjust the appraised values. You get the same shape curve, also pointing towards, around 22 years, and then you have plus 1, 2, 3 standard deviations up and down to show the uncertainty or the volatility of the aircraft values. So what drives this uncertainty now? Well, there is age depreciation, and you don't know exactly how quickly an aircraft will depreciate based on age. You have cyclicality, when sometimes you have strong markets and sometimes you have weak markets. So when traffic growth is strong and there isn't a lot of capacity around, then the cycle is good and aircraft values go up, and when the market is poor, then values go down. And then you have the maintenance condition of the aircraft that would affect the value quite dramatically, especially for older aircraft, where the maintenance value of the aircraft is a bigger proportion of the total value. And then you have inflation, which will affect the value, of course, and that's hard to predict. And then you have something that I call instantaneous price uncertainty, and that is simply that even today with spot market prices, you can't exactly pinpoint what the value is. All these drivers of aircraft value uncertainty are stochastic processes, or can be modeled as stochastic processes. And let's look at each of these a little bit more in detail. So when you look at value retention, one thing that determines value retention is if the aircraft is a successful aircraft or an unsuccessful aircraft. So here you have an example of the DC-930. That is a very old type, but it was very successful. It had a value retention over about 30 years. And then you look at the Boeing 717-200, which ironically is a derivative of the DC-930. But that had only about half as long value retention as a DC-930. And why is that? Well, as I said, it was a derivative of a derivative, and when the DC-9 came out, it was a very modern and advanced airplanes with only 2 pilots and 2 engines and very fuel efficient and very well performing, so it was very popular. When the 787 came out, it was already kind of quite old technology, and it didn't sell very well, so the value dropped quite quickly. So there are successful airplane types and not so successful aircraft types, and sometimes it's difficult to tell ahead of time which ones are going to be successful and which ones are not. Then you have another driver, and that is, is the airplane early in its production run or is it late in its production run? And here you see an example of the MD-83. The blue line is the first year model of the MD-83 that came out. And the red one is the last year model of the aircraft that came out. And you can see that the last of line aircraft depreciated much, much faster than the first vintage aircraft. Huge difference. So here you have to be very careful, beware of last of line aircraft. Now, I think the MD-83 was quite extreme because the first vintage and the last vintage were relatively identical. But for example, for the A320 that has been in production for a very long time, since I think 1986 or around there, and still in production, or at least until last year, that aircraft has gone through continuous development and improvement. So in 1986 A320 and the 2018 A320 are quite different animals. So it's not as bad as you saw here with the MD-83, but it's something to keep in mind. And then the third one, cyclicality, just to illustrate what it is. This is an example of a 1988 737-300. And this is the Ascend CMV that has been given by Ascend. And you can see that this CMV line here has been going up and down a little bit. If you take a trend line around that, here there is a red one, and you isolate that trend line, then you get the cyclical component, and you can see that the cyclical swings of the 737-300 actually got more and more violent the older the aircraft got, which is quite normal because, you know, the older airplanes, they're quite popular in an upcycle because everybody needs aircraft, but in a down cycle, those are the first airplanes to be parked. Different aircraft, of course, have different sensitivity to the cycle, but they all follow basically the same pattern. And where does this cycle come from? I think we should look a little deeper in this because it's such an important phenomena in our business, this cycle. And contrary to many other investment sectors, the cycle here is to some degree predictable. The drivers are traffic growth and aircraft capacity growth. And this is the reason why there is some degree of predictability, and that is that there are only basically maybe 2.5 manufacturers of aircraft, and it takes time to change the production rate. And you know, you have an order backlog, and the manufacturers will respond to that. So you can basically tell with quite a lot of precision how many aircraft will be produced over the next year or so. Then over the 2 years, a little less, of course, and then, you know, 5-6 years out, you have no idea. But in the short run, then you can slightly predict the capacity growth, and that means that you can also, to some degree, predict the cycle. And I think of this as playing blackjack and counting the cards. You know, you don't know exactly what is going to come out of the dealer's hands, but you know that the odds are moving in one direction, and you can account for that and place better bets. Same thing with the cycle in our industry. It's really a nice feature of our industry that you have that partial ability to predict the cycle. Traffic growth depends on a lot of different factors, such as world GDP growth and, you know, oil prices and, you know, aircraft technology, politics and demographics, etc., etc. And then, you know, world GDP growth also depends on politics and demographics, and it depends on oil price, and it depends on interest rates and inflation, and this can also be affected by outside events that are unpredictable, war and terrorism, pestilence. Pestilence is what we're seeing right now with the COVID pandemic, creating the deepest down cycle in the history of commercial aviation. And you have the oil supply shocks that have generated at least 2 historical severe downturns. So this is just a way to illustrate how, you know, the cycle happens with outside influences and trends and events. And you can see the cycle here affects aircraft values, and it also affects obligor ratings. And then those are also affected by the capital markets liquidity. I mean, how much money is out there. And that's something we see today. The cycle is super low down, but the capital market is very liquid, so there's still a lot of deals being done. Okay, but to go down into the cycle a little bit more in detail now, let's look at the components that drive this. Traffic growth first is representing demand for aircraft. And this chart shows you the annual traffic growth over the previous year as a percentage over time. And you see there's been some contractions in traffic. In 91, there was a war in Kuwait, and then in 2001 there was a September 11th attack, and then in 2009 there was the global financial crisis. And then this chart was done, I think, 2 years ago when I first did the UCD lecture. But of course, in 2020, we had an extremely severe traffic contraction that will generate the deepest down cycle in history, in our history. And then the other side of the capacity growth, okay, I count that in seats. Very often you see, statistics over aircraft deliveries, but it takes 5 Embraer 175s to make up for one A380. So you can't count them as, they're not apples and apples. So to put everything on equal footing, looking at seats, in other words, the aircraft times the number of representative seats in that cabin. And if you do that tracking here, you see that this is the production of new seats, deliveries from the manufacturer. And then you have, of course, scrapping and retirements, conversion to cargo here. So that's a deduction of the capacity. And then you have the net, which is the black line, the net seat growth. So if you put these two lines on the same chart, the green one is the annual traffic growth and the red one is the annual seat growth. You can see that there are some times when traffic has grown faster than capacity, and sometimes capacity has grown faster than traffic. And this is bad because that means there's too many aircraft. So, nobody wants airplane prices go down. Airlines are not making a lot of money because not a lot of people travel. They have too many airplanes, so ticket prices go down. So this is bad. This is good. This is the opposite. So if you now take the red area and the green area and you accumulate these areas going from the left to the right, okay, you get this line here, which is an interesting line because it shows two things. One is that there's a trend line here, which is an upgoing trend and means that every aircraft seat has produced more and more revenue passenger kilometers. And the reason for that are twofold. One is that there's been stronger growth in the long-range markets where aircraft spend more time in the air. They can do that because you can still depart and arrive at convenient hours of the day while the passengers sleep during the flight through the night. And the other reason is the proliferation of low-cost carriers where you can actually sell a ticket to go from Luton to Barcelona for £25, and you say, well, the catch is that you depart at 2:30 in the morning and you arrive at 4 o'clock in the morning. So it's inconvenient for you, but the price is super cheap. And this is why, Ryanair flies, 12 hours per day on average, whereas network carriers, 20 years ago would fly maybe 6-7 hours per day with their short-range aircraft. But this trend is not going to go up forever because 100% cabin factor is the limit and 24 hours a day is also the limit on utilization. So it's going to eventually taper off. But around this trend line you have this cyclical component, and if we isolate that, you get what I call the pent-up relative capacity shortage surplus cycle, or PERCS. So when this is on top here, it means that there is actually too few aircraft for the demand in the market, in this case by about 9% compared to like a long-term equilibrium. And here you have a surplus of capacity by about 10% relative to the long-term equilibrium. So this has been going up and down. There's been good times and bad times. And this PERC cycle totally correlates with aircraft value curves and also with a default frequency among airlines. Now, when I did this chart 2 years ago, I was expecting that we would go into a downturn at some point, but I had no idea that it was going to be so deep and so rapid. And the thing is that this is also a stochastic process. The forecast of the cycle is definitely stochastic. I said we could have some predictability in the cycle thanks to this, inertia in the production system, but it's only partially predictable. And here, of course, there was a huge forecasting error. Then we have the maintenance condition of the aircraft that will affect the value. And you have other lecturers that have or will speak more about this in detail. I will just briefly mention that you have the airframe and the gear, which is calendar time based with fixed intervals. And you have a cost for a A320neo of about $2.5 million for the landing gear overhaul and the 6-year check and the 12-year check. And this type of overhaul schedule will result in what I call the sawtooth value adjuster here, up and down. Now these intervals here can be predicted quite well because it is calendar time, so it's hard stop at calendar time. For engines, you have two sides of it. One is the life-limited parts, which are basically mainly the discs here that the blades sit attached to, and they have hard stops for flight cycles. And then you have the engine refurbishment, where you kind of fix or replace the blades and so on to make sure that the engine is aerodynamically super efficient, because these blades they get dented and they pick up dirt and gets corroded, so they become less and less efficient, and they convert less and less of the fuel energy into kinetic energy, and some is lost in heat losses. So that's why you measure the exhaust gas temperature, and when that gets too high, then you have to refurbish the engine. So this is an on-condition requirement. So lessors and airlines keep empirical data on what those achieved intervals will be, so that it's statistically based, and it depends on how the airplane is operated and where it's being operated. So there's uncertainty around those intervals, and there's also uncertainty around the costs. The costs for the life-limited parts are quite clear, because they are published in the manufacturer's price list, and then you have the limits, cycle limits for these life-limited parts. Some are longer than others. And then the refurbishment, you have these 4 modules, and the bucket cost here is about 3.2 million for the LEAP engine, and the LP stack is about almost $5 million. And this will give you these saw teeth charts here for the refurb and the life limited parts. You can see there are 2 engines on an airplane, so it's a huge cost. And this is not totally predictable, because you can't predict exactly the operating mission of the aircraft. So there is stochasticity in this as well. Another one that drives aircraft values and projections is inflation, and inflation is hard to predict. You can see the effect of inflation on the DC-1030 from 1972. This blue line is the nominal appraisal of the aircraft, and the red one is adjusted for inflation. And you can see it was huge during the 70s and 80s and early 90s. Inflation was really very high, and this means that a lot of the lessors and also the banks that lent against aircraft did very well, because unexpectedly the aircraft would not depreciate. It would actually sometimes appreciate for long periods of time. This is a luxury that I don't think we're going to see again for quite a long time, unless these bailouts and money printing that is going on now would result in higher inflation. But I think that the economists are not in complete agreement of what the outlook is for inflation in the future. Now, when I say inflation, I'm not talking about the escalation of aircraft prices. I'm thinking about the consumer price index that just tells you how much can you buy for $1, and it's like the value of the dollar rather than the price of the aircraft. One thing that is related to inflation is currency exchange rates. And you see most leases and most loans for aircraft are denominated in US dollars. And that is something that I think over your 30 or 40 year career that you have ahead of you, you're going to actually see that leases and loans will be denominated more and more in other currencies. The US role in aviation has gone from 50% in the 70s to 20% today, when I say the airline industry. And you know, it just doesn't make any sense for Ryanair to lease an aircraft in US dollars when all the revenue is in British pounds or euro. And I think that you know, you can learn to manage these currency exposures by denominating in dollars. Sorry, your leases in other currencies than dollars, and also then create your liabilities in a matching currency. And then the instantaneous price uncertainty is because, you know, no two aircraft are alike. They're all, you know, individuals, and the exact condition of the aircraft is not really known to the buyer. And you have important customization costs. So if you move the aircraft from one operator to another, it will be costly, and also the value of the aircraft is different for one operator against another. Say, for example, you have an aircraft in a THY spec, so all the business class seats and in-flight entertainment system is to THY spec. Well, that aircraft is more worth to THY than to British Airways. And then prices are opaque. I mean, you can't see the price or the value of an A320 from 99 on Bloomberg's. If there is a trade, it's not disclosed publicly, so it's really hard to pinpoint what the value is. And also, there are very few transactions involving naked aircraft. Most sales are encumbered with either a lease or warranties or crew training commitments or spare parts provisioning. So it's hard to distinguish in the overall price what is a naked aircraft and what are these encumbrances. And then you can just get a sense of this instantaneous price uncertainty by looking at how widely different appraisers can be about their opinions of aircraft. But there are different aircraft. I mean, you know, some of the typical popular narrow bodies, the appraised values cluster closer together, and for you know, some wide bodies or not very liquid aircraft, then the prices will diverge more. So this was about the current market value, but since we do a lease or a loan that stretches over many years, we have to make a projection of the aircraft value. So we have to kind of come up with a value curve that is fundamentally a guesstimate. And the only guide we have is history, but we can't tell exactly what's going to happen in the future. So to recognize that, instead of having just one curve, we show a range of possible outcomes of the value in the future. And that is illustrated by having +1 and +2 and -1 and -1 standard deviation around that value. So we're saying here that between these two lines, we are 68% confident that the value will end up somewhere here. And you see the instantaneous price uncertainty already here, because this band of variation is open already from the beginning. In this case, we say we know when the maintenance events will happen. In reality, we don't, so the curve is going to look a little smoother like this. And here we don't have any maintenance reserves, but if we add maintenance reserves, you see that the level here goes up with the value. And it also takes some of the uncertainty away, because the whole uncertainty around the maintenance condition is absorbed by the maintenance reserves. Another way to illustrate this uncertainty in your value projection is to look in the other dimension and say that, okay, so this is the value of the aircraft here on the horizontal axis. This is today, the current value, and you're not absolutely sure, so there is a distribution that is quite narrow because you have relatively good idea of what the value is. And then as you go out in your forecasting horizon, the expected value will go down, so you see this moves to the left, but most importantly, the standard deviation, or the width or dispersion of this distribution, becomes flatter and flatter, and 6 years out it's quite flat, because you're more and more uncertain about where the value is going to end up. So when you have a system or a method to forecast values, just like you did with obligor ratings, you have to back test and calibrate. Again, estimate the value, back test it, and recalibrate the system. And here, because this is a continuous variable, so the value can take any value between 0 and infinity, the things you need to look at when you look at your forecasting accuracy is precision, in other words, the standard deviation of your errors in your forecasting, and the accuracy, and that is a systematic average, or the mean of your error. So let's look at an example of when we predict aircraft values. So if we record a forecast of a value, say in December 2000, we did this forecast here, year by year. So in 2000 we said that this aircraft was going to be worth 17.3, 18 years later. And then we asked the appraiser, and the appraiser said after 1 year, well, the value is 94.97. Okay, good. We had forecasted 90.83, so we had an error here after 1 year, which was the difference between 94.97 and 90.83. So that was an error. And then we did a new forecast starting with this value out here into the future. And we did this subsequently for 18 years. And then we had this matrix that would allow us to measure the forecasting accuracy. So the appraised line is this red line. This is what actually came out over the 18 years from Ascend. And the black line is, sorry, I take that back. The red line, it was the original forecast we did. And the black line was the first forecast we got after 1 year from Ascend. And you see we were a little bit under predicting the value. Ascend came up with a slightly higher value. I apologize for that mix up. So the red line is the original forecast. And then after 3 years, we have these data points from Ascend, and we're still, under predicting the value. And then after 9 years, you see now all of a sudden we overpredicted on the 9-year horizon. But after 18 years, we ended up smack on here. But there's been errors along the way. And if we now add all the subsequent projections we did of the value, with the benefit of knowledge about what Ascend then said that the value was, we get all these red lines. And from this scatter, we can establish the forecasting accuracy. So just to take an example of how you would track that. This is a 737-800, and we did a projection in the second quarter of 2015. And you see that on the 1 quarter horizon, we had a little error here because we forecasted a too high value compared to what the appraiser said the value was. And then after 4 quarters, or 1 year, we had made some subsequent quarterly appraisals. You can see that there is a little bit of a scatter around in the forecasting error, but the average is relatively smack on the line. And then we continue, into 3 years, 12 quarters. And then you have an average error that has built up here, where we have underpredicted the value a little bit, but we have some volatility around that prediction. And if we go the full horizon out at 22 quarters, you can see that there is quite a bit of dispersion. This was for one aircraft. If we now take all the 164 aircraft that we had in the portfolio, we see there is a much more of a dispersion of the values, and that is because, of course, with more aircraft, some we had completely misjudged the maintenance value of the airplane and cycles and so on and so forth. So this is a little bit more wider spread. So on average, we underestimated the value, and we can see here what the precision was around that prediction. And if we take a whole portfolio with many different aircraft types, you can see that it was not, it was predicted relatively well, the average error, but the dispersion here is very wide. And if we just take narrow-body aircraft, you can see that there is a tighter distribution around just the narrow-body aircraft. So what drives this volatility? We saw that narrow bodies seem to be a little bit easier to predict the values of than wide bodies. And to determine the volatility of aircraft, you could give the aircraft a score, just like you give airlines a rating. So to give a score, there are many different ways to do it, but you could have a scoring system, and in the scoring system, I think you should have basically two basic properties. One is what I call liquidity of the aircraft, in other words, how easy it is to trade, and the other one is a currency, and how good is the aircraft, how performing is the aircraft. So under liquidity, you can look at things like number of deliveries, number of orders, number of operators, and you can see how those delivered aircraft are concentrated among the operators, and get the concentration index, the HH index. That index is important because, even if you have a lot of aircraft delivered, if they're all with American Airlines, it's not very good, because if American Airlines would go bankrupt, there would be a lot of this particular aircraft type on the market, and prices would be probably affected. So diversity in operators is very important. The homogeneity of the airplane is important. So if you have an airplane with 3 different engine selections, a lot of different cockpit instrumentations, that is bad, because it means that the airplane is not going to be as easy to move from one operator to another. And the switching cost as a whole, of course, is very, very important. And then on the currency, you have the basic performance of the aircraft, the size, the range of the aircraft, operating costs, like fuel burn, very important, maintenance costs, if the airplane is convertible to cargo is a plus, etc., etc. So you can look at these different attributes and score them and weigh them and come up with some kind of overall score that would somehow represent the volatility in that aircraft and your ability to predict the value. Now, the thing is that guessing aircraft values in the future is, as I said, a guess, and there is uncertainty, and you cannot really nail this down. But the important thing is that, okay, you can always address the systematic error by recalibrating your system. But the standard deviation is going to be hard to eliminate. But that is in the nature of the beast. There is uncertainty. But at least here you have quantified how uncertain you are about this value. And this is super important, because that will allow you to quantify the asset risk. Another thing you can do to look at aircraft volatility is just to look at the dispersion between many appraisers. And you can look at investor polls that will give you scores of the most popular aircraft. It's always some help. Whenever something is difficult to do, try to always to triangulate between many different sources. So now we have talked about what the aircraft is worth. But we need to get hold of it. So the question is the airline going to return the aircraft when they have defaulted, or do we need to repossess with the help of courts? And are the courts going to be efficient? Is the process going to be smooth? Is it going to be very costly and time consuming? So that is what we're going to turn to now. I mentioned jurisdiction risk. And that is the risk that we cannot transfer funds from the operator's country because of restrictions, for example, in the banking system. But it's mainly the risk connected with the time to repossess and deregister the aircraft, and the cost to repossess and deregister the aircraft. To some extent, we have also to take into account the time to repair, reconfigure and remarket the aircraft, and the cost to repair, reconfigure and remarket the aircraft. These are not really jurisdictional risk components, but they are important in our calculation to be able to calculate the net present value at a particular outcome if we have a default, or that we come to the balloon or the end of the lease term. The data behind the jurisdictional risk can be derived from the laws of the country where the aircraft is registered or operated, to see if the country has signed and ratified the Cape Town Convention. But even if the laws are clear and Cape Town is ratified with good declarations, then the judicial system has to be efficient. And there are examples of countries that have quite good laws and they have ratified Cape Town, but still there's been problems with very slow court systems, and that has delayed repossession. And then something that you can look at is the corruption index of a country. Very often the level of corruption is indicative of how easy it is to be able to enforce your rights as a lessor or lender. And there is an organization called Transparency International that keeps a corruption index current. That's very helpful. You have country risk ratings by various organizations that are interesting and can be of help. Then there is a structure of your contract and the registration country of your aircraft, and you can kind of structure around jurisdictional risk. Very helpful is empirical databases that larger lessors and banks can build up over time, where they have specific examples of repossessions where they have recorded the time and the cost associated with recovery. And again is an example of how important it is to always record what has happened in the past and store that data and use that data to be able to take smarter decisions in the future. Another hint of the level of jurisdictional risk you can gather from the price of repossession insurance. Then we're going to turn to interest rate risk. So first, on interest, there are three components of interest. One is the risk-free rate, and that is simply the time value of money. So how much do I prefer $1 today versus $1 in 1 year? Where the collection of that dollar in 1 year is not the question about it. I know I'm going to get it. It's just that, do I want to have it now or can I wait? So that's a risk-free rate. But then if you get a promise from somebody to give you $1 in 1 year, and you cannot totally trust them because they may not have that money in a year from now, then you have to compensate for that risk of not being paid. And that requires a premium, and that is typically what lenders do in their loan margin. And then there is typically a premium to compensate for the lack of liquidity. So in other words, if you have a promise from somebody to pay you $1 in 1 year, say then the next week you need that $1. Well, can you sell your claim to somebody who can readily pay them the money and take over the claim and then collect when the year is over? Well, that's important, and for aircraft loans and leases, they are not super liquid because there are quite high transaction costs and search costs. So there is definitely a premium for the lack of liquidity in aircraft leases and loans. So why does interest matter for us? Well, first, the discount rate that we use in the net present valuing is uncertain, because we don't know what the rate is going to be out in the future. We know the rate today, but we don't know the rate in a year or two from now. And then interest rates and inflation are correlated, and I have illustrated that here in this chart, where you can see this is the 1 month LIBOR rate, and this is the inflation. This is the US CPI inflation. And you can see that although this doesn't line up like a string of pearls, it is clearly a correlation where you have high LIBOR, high inflation, and low LIBOR, low inflation, or even deflation here. Then interest rates matter because of much funding. I mean, when you have a lease with a fixed rate lease rent, or a loan with fixed interest rate, and you finance that, you need to match that funding so you don't get squeezed between escalating rates on one side and fixed rates on the other side. And also on fixed rate leases and fixed rate loans, you run the risk that if there is a default or an early termination, that you're going to be stuck with your fixed rate arrangement or your swap. And to break that swap may cost you money. You may also earn money on that, but there is, increased volatility and therefore increased risk. So we need to look at interest in our modeling of the net present value. So on the interest rates, what you typically look at is the yield curve, and the yield curve is just a chart that shows on one hand the duration of the loan or the bond, and then you have the rate on the vertical axis. And you can see this yield curve from December 2013, for example, was very steep. So in other words, short-term interests were low, long-term interests were higher. But in 2018, this curve had flattened substantially. And to see the evolution over time, you can plot the diagram like this. So here you have the calendar time, and then you show short rates and then different durations, and the higher durations are higher up. So you can see here that, for example, in 2003, the yield curve was quite steep because the difference was high between short-term rates and long-term rates. In 2006, you saw that the long-term rates and the short-term rates were quite similar, so you had a flat yield curve. And then interest rates fell dramatically here after the financial crisis. And then rates have gone up a little bit, but you also saw the yield curve flatten. Now, again, this is a chart that is not from today. And of course, now interests have fallen down dramatically. And this is what people speculated in, that you would have a flatter yield curve. It was like a precursor of a downturn in the economy. So we have to simulate this yield curve in the modeling of our loans or leases. And this just shows you an example of one scenario where you have the short-term rate and you have the longer rates here. And then you have this phenomena built into your model that when the rates are high and the economy is at the top, then you have a flatter yield curve, and that's typically preceding a lowering of interest rates, which is typically goes along with a weaker economy or a recession. Another scenario looks like this, a third scenario like this, a fourth scenario like this, and on you go. And the key here is to try to estimate the swap breakage cost over the duration of your lease or your loan. So the expected swap breakage cost is, of course, not going to be very high because you can't really predict interest rates, and the best prediction of the interest rate is already embedded in the current yield curve. But you have volatility in the yield curve, so that will give you this standard deviation up and down where you have breakage cost and breakage gains. And although it is kind of neutral on average, just this volatility drives additional risk. This particular curve for the swap breakage cost is for a bullet loan, and you see that once you go through the duration of the bond, this volatility starts to come down because there's a shorter and shorter period of time for the differences in interest rates to play into the present value of the cash flow stream, and that means this goes down, and at the end that swap breakage cost has expired because there is no duration left on the bond. If you have an amortizing bond, that is even more pronounced because the average remaining life goes down much more quickly on the amortizing bond. Okay, so now we have covered uncertainty and risk with respect to default risk, aircraft values, jurisdictional risk, and interest rate risk. And how do we now tie all this together to help us take better decisions? Well, what we can do is to generate multiple scenarios with different outcomes. In one scenario, the airline may default and we get the aircraft back quickly and it sells for our outstanding exposure or above our book value. In another case, maybe there is a default at some point and then the aircraft is not worth that much and we're actually going to make a loss. In another scenario, maybe we reach the maturity, but we have a booked residual of the aircraft that is higher than the value of the airplane. So there is a multitude of different scenarios that could play out. For each scenario, we can calculate the net present value of this outcome. And we can collect those scenarios and build a probability distribution of the net present value. And from that distribution, we can then extract meaningful investment performance and risk measures. And that's what I'm going to take you through now. Dynamic investment analysis. In this approach, we discount the cash flows using the risk-free rate. And this is different from the static NPV analysis, when the discount rate is supposed to reflect the risk. But again, for reasons I mentioned earlier, that it's not the weighted average cost of capital that is relevant here, since every deal has different risk properties. We need to account for risk specifically based on the investment that we are contemplating. So the risk adjustment we will do later on, after we have finalized doing the probability distribution of the NPV. So we're going to build that NPV distribution as a probability distribution, and we're going to, from that distribution, derive risk and performance measures and do those risk adjustments. There are other aspects to this that we will not have time to cover in this lecture, and that has to do with diversification, cross-collateralization in loans. This is when one loan collateral covers exposures on a different loan to the same borrower, and also look at portfolio net present value rather than just the present value from a particular transaction. We're not going to have time to look into that in this course, but this is something that we could maybe talk about at some future date. Also, another thing that I want to mention about the value of a loan or a lease, there is a difference between what the market value is and what the internal value is. The market value is what you can sell it for in the open market or buy it for in the open market, whereas internal value has to do with your funding cost, your tax situation, and your operating costs. So some deals may fit you very well in your company, and other deals may not fit that well. So this is different from the market value. And this is why people trade with one another, because they try to optimize the portfolio from their perspective. So for example, a company that has very high funding costs, for example, wouldn't want to do super senior loans with very low margins, because sometimes they have to pay more money for borrowing up to finance these investments than they earn on the loan. So it doesn't make any sense. So that would be, a highly rated bank that would do that type of business. And somebody with high funding cost may have to do something that is a little bit more risky, that commands higher margins. Now, to be able to evaluate transactions and optimize transactions and structure transactions, we have to have metrics for risk and performance. And this is, I think, a little bit of a situation in our businesses that people talk about risk and reward in very qualitative terms, and rarely do you see explicit risk measures being used. But I'm going to introduce to you a number of risk and performance measures that I think can be very useful. So to make it simple to start with, instead of doing an aircraft loan or an aircraft lease, we're going to play a game where I'm going to flip a coin, and if heads comes up, then you win $20, and if tails come up, then you lose $10. You have to pay me $10. Okay, so the present value, or in this case earnings, because there is no concept of payments in the future, this is all now that we play this game. These earnings are uncertain because we don't know what's going to happen when we flip the coin. But the good thing is we know the outcome, the possibilities of this coin flip, heads or tail, And we know the probabilities. So, the first scenario is that you get 20 bucks, and that can happen with a 50% probability if the coin is fair. Or the second scenario is that you lose $10, and that is also going to happen with 50% probability. So now we can illustrate that in a earnings probability diagram. So you basically have the two outcomes, minus $10 here with 50% probability, or we have $20 earnings with also 50% probability. Another way to express this graphically is to do a cumulated probability diagram. So here we accumulate the probabilities going from the left to the right, and when we do that, we go here from the left and we hit minus $10, and here all of a sudden we have 50% probability that that is going to happen, and then we continue to the right, and the next event is that we have a $20 possibility with 50% probability to happen here. So this would be the cumulative probability distribution, and that is sometimes an easier way to illustrate a game like this. If we now have an aircraft lease, the distribution is continuous because there are an infinite amount of different possible outcomes, and because we have both upside and downside, it's more of a bell-shaped curve. And you can see here that in many of the scenarios we will end up on the positive side of the earnings axis, so we're making money. But in some scenarios we're actually going to lose money, and this red part here is called the loss tail. And you can see this chart, it resembles a bell curve, but it's not totally symmetrical, typically for an aircraft lease, for a variety of reasons. And the tail is typically a little fatter than you would find in a normal distribution. These cash flows here in these different scenarios that have been generated have been discounted at the risk-free rate. In a loan, it looks different because here we have an absolute cap of the earnings, which is the margin and the fee income we make, and we kind of know what that's going to be, and we collect that if the borrower pays through the term and there is no shortfall or recovery. But then there are scenarios that can occur with relatively low probability, hopefully, that there is a default sometimes during the term, and in many cases you still recover your loan amount by then, but you don't earn all the margin income. And in some cases the aircraft value will be low and you will actually have a shortfall in recovery and you're going to go into make losses. Okay, so on in a cumulative distribution, these two transactions would look like this. The operating lease is this typical S-curve, and the loan is more of a wall here, and then you have the loss tail. And you can see that the loss tail is larger for an operating lease because you have more exposure to the aircraft. You typically have an LTV of around 100%, whereas on a loan you may have a lower LTV, you should have. So you have a lower loss tail, but you also have a cap on your earnings. But you can see also that the loss tail here is very long, and you can't really see the difference between this domain and this domain in the chart. So one thing that you can do is to transform this vertical probability axis into a logarithmic axis, and then you get this shape of the curve, and now you can see much better what the loss tail looks like, and you can see clearly that there is more loss risk in the operating lease, but also more earnings potential. Now, if we want to look at performance and risk measures, the first thing we should look at is the expected net present value, and that is the average of all the outcomes, or the mean of the distribution. And in the case of the coin flip, which is a discrete event where we have a countable number of outcomes with assigned probabilities, it would be this formula here, where you have the sum over all the outcomes for the different scenarios multiplied by the probability that that scenario will occur, and then you just sum it up, and that gives you the average expected earnings. And in the continuous case, the summation symbol is replaced by an integral from minus infinity to plus infinity, because the outcomes are basically infinite. And you take the value function multiplied by the probability function, in other words, the probability as a function of the value, and you integrate that, and that gives you the mean net present value, or the average. Okay, so in the coin flip game, the expected present value, or the earnings, this is a discrete case, so it's one scenario, which is minus 10, that you lose 10, right, times the probability 5, plus the other scenario that can happen, that you gain 20, times the probability of 0.5. So if you do this arithmetics, it's $5. So you have a positive expected present value of 5. Now, is that the value of this game? Is this what you would pay to play this game? Probably not, because why would you rather play this game and risk losing $10 rather than having 5 in your pocket? Or you may say that, well, I can earn 20, and that's better. But here the question is, are you averse to risk, or do you love risk? If you go to a casino, then you clearly love risk, but that's for entertainment. In investment, everybody's risk averse. You don't take more risk than you need for a given expected return, and you don't want to have, for a given risk, you want to have a certain return. So let's look at the loss measures then that you have to compare this expected earnings with. So in the discrete case, the expected loss is simply, it's the same formula, except that you go through all the scenarios where you have a negative outcome. In other words, all the scenarios where you lose money, and you sum them up. And that gives you the unconditional weighted average loss. And in the continuous case, it's also the same formula as in the previous case with the expected net present value, but you go from minus infinity to 0. In other words, all the scenarios where you lose money are multiplied by the probability of occurring and then summed up. For the coin flip game, this measure is simply the one outcome where we lose money, minus $10, times the probability of that scenario occurring, 0.5. And then, because it's called a loss, you take the absolute value of this, and that's $5. This loss measure is interesting because it is really what you should set aside as a reserve in your portfolio. And if you do that, you should be, if you count correctly, you should be able to, on average over time, have enough reserves to cover losses that may occur across the portfolio. Of course, you cannot predict exactly what's going to happen in one deal, and therefore expected loss doesn't mean that you are expecting to make a loss. It just means that this is the average loss that you're going to make over time if you do a lot of deals, and over a long period of time. Another risk measure that is kind of interesting is the valued risk, and this is like an unexpected loss. This is when things go really, really bad. And this is useful not so much on individual transactions, but it's useful for portfolio management and for calculating the leverage and capital you need to have in your portfolio to make sure that you don't run into a bankruptcy situation. So then you take your net present value distribution and you say, what is the biggest loss that I will not exceed with a given confidence. So in this case, I have value at risk at the 99.9% confidence level. That means there is only a 0.1% probability that I will exceed the loss. And that is the intercept with the distribution here at this point. So in this case, it's $9.5 million that I have as value at risk. And then what is the coin flip game value at risk? Well, it's almost trivial because you only have one scenario where you lose money, and that you can lose 10, but you can lose 10 with 49.99% probability, and you can lose a 10 with 0.1% probability. So it's like it's not really meaningful for that game, but it is the maximum loss you can have. Another risk measure would be the probability of loss. And in that case, you simply take the integral from minus infinity to 0, in other words, all the scenarios where there are losses, and you integrate the probability function, and that will give you the probability of loss. And in the coin flip game, it's very simple because the only scenario where you have a loss has a 50% probability, so that is the probability of loss. Then the question is, so what deals do we want to do? And one way to look at that, and also to help in structuring deals and pricing transactions, is that you look at a ratio between risk and reward. You will hear that term, risk-reward ratio or risk-reward properties, a lot in our industry, but rarely is this defined mathematically what people actually mean. And in this case, we have a ratio like this, which is simply defined as the ratio between the expected loss and the expected present value. There are many performance measures in the investment space like this. You may have heard about the Sharpe ratio that is used by wealth managers and asset managers. And there's also other measures like the Omega measure, which is very close to the risk-reward ratio. But this is not that important. The important thing is that you compare your expected earnings with your expected downside, and you develop some type of ratio that you can hold on to when you price and structure transaction. And it can also then define how far you go, how much risk are you willing to take. You've heard about risk appetite and risk limits, etc., etc. But again, this is very often qualitative and not quantitative. So here you actually have metrics that you can calculate what your risks are numerically, and you can set up numerical limits. In the coin flip game, we saw that the expected loss was $5 and the expected PV was also $5. So the risk-reward ratio is 1. And we will see if that is attractive a little later here. Okay, then one thing that is very useful is to say, okay, I have this lease an aircraft with a lease attached, and I want to know what the mark-to-market value is. In other words, if I look at my book value, is the value at which I can sell this asset at higher or lower than my book value? Or a loan, for example. I mean, a loan is carried at par in the books, so the outstanding principal. But is this a loan that I could either sell if I have it at a higher or lower price than the book value? Or is it one I could buy from another bank at above or below par? So this is called the mark-to-market value, but you can't be sure that it's going to sell for this in the market, because market prices for these bespoke assets that leases are and loans are do not trade on exchanges, or you can't see it on Bloomberg because they're all bespoke and unique. So it may be better to refer to this as the mark-to-model value sometimes, because it says this is what the model suggests your valuation should be, but it's not always exactly what you can sell it for. The definition of the model value, or the MTM, is quite complex mathematically, and this is not really something you can solve analytically. And this formula here, don't worry about this. This is only for true nerds if you want to kind of dig into this and see how it works. But for everybody else, you can illustrate this in the NPV cumulative probability diagram here. And you can see if I have a loan, in this case a loan, that is represented by the green NPV distribution. And I calculate a risk-reward ratio for that. And I find that that risk-reward ratio is, say, 5%. But then I've seen that a lot of people out in the market are doing deals today, and I see that the risk-reward ratio cluster around, say, 10%, so a higher risk-reward ratio. Then I say, well, that seems to be some kind of market benchmark risk-reward ratio, and I should compare my deal to that benchmark. So if I decide that 10% is the market benchmark, and I see that my deal is actually 5%, I can move my distribution to the left, so from the green towards the blue. And when I reach the blue line, I will have a risk-reward ratio of 10%. So that means that I've been able to move this particular loan here on the chart by an amount of, what is it, like 5.4 million, about 2 million to the left. So that would suggest that my loan here has a $2 million mark-to-market adjustment. So I should be able to sell this for $2 million more than the face value. And conversely, if I buy a loan, maybe I find that the loan has a 20% risk-reward ratio, then I don't want to pay par. I want to buy this loan for a discount. And so that's a movement in the other direction of the distribution. So this mark-to-model or mark-to-market translation of the diagram is simply equivalent to deducting or adding a cash position to your investment. Now, the risk-reward ratio, that is the market benchmark, this is not something that everybody will agree on, because different investors have different views about different aircraft types and their valuations and their volatility and airline ratings. But you will still see that typically this risk-reward ratio, from your vantage point, clusters around a relatively narrow range in any given market. So the coin flip game, what is then the risk-reward ratio? What is the mark-to-market value if you have a benchmark risk-reward ratio of 10? Well, it's minus 7.5. And I'm not going to go into the calculation of that, but you may, have fun trying to figure that out. Then sometimes you talk about the risk premium. We want a risk premium for this deal. So what is the risk premium? The risk premium is simply the difference between the expected present value and the mark-to-market value. So if the deal is risk-free, then your risk premium, if the mark-to-market, if your deal is risk-free, your mark-to-market value is going to be the same as the expected present value, and your risk premium is going to be 0. And the risk premium in the coin flip game is 5 minus 7.5, so that's 12.5. You can see that is a very different number from the expected value, so the risk premium is very, very high. So probably not a good deal from an investor's point of view. Maybe from a gambler's point of view it could be fun, but not from an investor's point of view. But now we're going to do something more interesting. We're going to take this coin flip game, but we're going to do 10 flips and see how that changes the investment properties of this game. So if you flip 10 times, and every time you have heads up you win 20, and every time tail comes up you lose 10, then there are large amount of possibilities. I mean, you can follow this lattice here in many different ways. And then the end situation after 10 coin flips, there are, I think, 11 different outcomes, if I'm correct. You can verify that. And the path to get there are many different paths that you can go to reach any of these points. So to calculate now the properties of this game from a loss and performance perspective, you need to have probabilities assigned to each of these final states, these final outcomes. And to do that, this also shows a distribution of the frequency of different outcomes, and you can see that the most common outcome is that you actually make $50. All right, but you can make up to $200 if you win all 10 coin flips, but you can also lose $100 if you lose all your coin flips. All right, but there's a very low probability around that. So here you see the histogram showing that probability distribution. And to calculate what these probabilities are, you can either use the binomial distribution, which has this formula. And again, this is for nerds mainly. You can look this up in Wikipedia or if you want to, and if you want to replicate these calculations. I did it in Excel just for fun. And I found that the average outcome then is $50 and the expected loss is $3.71. So that is simply you take the probability times the earnings, you put in this cell, and then you take this probability times the earnings and put in this cell, and then you sum all these up, and you get $50. And if you sum all the ones where you lose money, then you get $3.7 expected loss. And so the risk-reward ratio is now 7%. So you see it went from 100% when we do the single coin flip to 7%. And the low risk-reward ratio is much better. So this is a far more attractive game than the single coin flip. Okay, and if I accumulate the earnings here, the probabilities, I can plot this diagram, and you see that these are discrete outcomes. You have a scatter diagram showing this typical S-curve, what it looks like. Okay, and then if you don't want to be bothered with the binomial distribution, you can do this in Excel, and it's not that complicated because there is a formula in Excel, or a function that is called RAND, and then just a blank parenthesis. If you type in an Excel cell equal to RAND and then a blank parenthesis, you will get a number between 0 and 1 that is randomly distributed according to a uniform rectangular distribution. So in other words, every outcome is just as likely. Okay, so to simulate the coin flip, then you write in the formula equal to if the random number is bigger than 0.5, then you make $20, otherwise you lose 10. And then to accumulate your earnings in the 10 subsequent coin flips, you have to add the result from the previous column, in other words, this cell here. Right, so this formula is the same in each of these cells except the first one, where you don't have to include the previous because there is no previous column. Okay, so you do this in your Excel spreadsheet, and this is your final outcome in this particular scenario. And then, of course, to find out what outcomes you have on average, you have to do a lot of simulations. So you have to fill this down, and in my case I repeated this in 25,000 rows, but you can do more rows if you like. It's a pretty big file, you can't really email it, but it will probably fit on your computer. So you build Excel spread to generate the random cumulative earnings outcomes like this. And then the next step is that you copy paste the whole sheet and you copy and paste values. So these will not be transformed to values. So you see that the final outcome in that first row is 110 hard-coded. Okay. And then what you do is that you delete all the previous columns and just keep this one that has the final outcome. And then you sort the sheet, from the lowest outcome to the highest outcome. So in the beginning, you're going to have several of these, worst outcomes where you lose $100. So that's going to be repeated several times. And each of these outcomes have, 1/25,000 of occurring because I had 25,000 rows. So that's why the probability is 0.004% for each of these scenarios. And then I accumulate them with this formula all the way down, 25,000 rows. And then I can plot a diagram. And this is the diagram for the 10 consecutive coin flips. And you can see that there's a very little probability that I will lose $100. And then here looks like it's about 17% probability that I will actually lose money. And then beyond that, I will have various probabilities to make money. The probability of making 200 is very, very slim, as you can see here. So this diagram just says that, there is a 100% probability that I will make less than $200,000 or less. Sorry, $200 or less. And then here it says that there is a 63% probability that I will make $80 or less. So that's how you should interpret this diagram. And then the other thing, to calculate the expected present value and the expected loss and the risk-reward ratio, what I need to do then is to multiply the outcomes with each probability, which is 0.004% in all the cases, since I have 25,000 rows. And then I calculate here in C, I'll calculate the outcome times the probability. Okay, and then I sum that up for all 25,000 rows here in this cell. But then I take in this cell the sum of all the rows where I had losses. So the first 4,262 rows, it turns out that I had a loss. And I actually scrolled down to see where that point was before I wrote this formula. But if you're sophisticated with Excel, you can write an if sentence here and say that if the number is negative, then you include it. Otherwise, you make it into a blank, and then you can do the sum of everything, because everything that is a positive outcome is going to be a blank in your summation. So you can get that number directly. So when you do that, you find out that the expected present value is $50. In this case, it was 49.999, and that's because I only have 25,000. And you can keep pressing F9, and you will have a recalculation. Not now, because I copy pasted, and hard coded the values. But if you have this sheet live, you will see that this varies a little bit, between 49.5 and 50.5. But if you go on and do, a million rows, then you will kind of converge against $50 exactly in most trials. And then the expected loss is 376, and that gives you a risk-reward ratio of 7, which I mentioned in the past. The probability of loss is 17%, which you could see from the graph. But the mark-to-model value is still, if I use 10% as a benchmark, is still minus 4.4%. So if I think 10% is the right risk-reward ratio, it's still not a super attractive game. Okay, thank you so much for listening and being patient. Now, you're going to get an assignment in writing. It's a Word document that is going to be sent to you, and you're going to solve that assignment within your groups. There are 10 questions, most of which you will discuss in your group and come up with an answer. There's one that is a exercise in Excel, and it's very similar to the exercise I took you through with the 10 flip coins. So I want you to do that same analysis that I went over with you, but there's one difference now, and that is that you're going to start with only $20 in your pocket, and that is all you have to play with. And that means that if you do 2 coin flips and you lose both times, you don't have any money left and you have to stop playing. Or if you win the first toss and then lose the 3 subsequent ones, you're out of money and have to stop. So you have to model that in Excel, that you stop the game when you run out of money. And I want you to see how that changes the net present value distribution and how it changes the expected outcome and the expected loss from this game. And then we're going to go over this assignment in a live Zoom session at some point in April, a date to be communicated. And after that, we're going to have another Zoom session together where I'm going to demonstrate to you a Monte Carlo tool that we used at PK and still use. And that's going to give you an illustration of how the content that we had in this lecture can be used in practice. So see you back then in April. Thank you so much. All the best. Bye-bye.